It's 4 o'clock, fellas. We'll get this thing started here if y'all want to. Um, so some of the stuff I'm gonna try to cover over here is just how to kind of size into some of this stuff and know ahead of time how much size you want to put on. Um, so you can kind of control risk that way outside of just having a stop loss. Um, just per se your normal trade size. Just for instance, say it's 3 contracts. Well, if you see a certain particular setup, right, you'll know ahead of time. Maybe you shouldn't do three there. Maybe do like one or two, and it'll kind of help control risk. But I'll go through that and show you. But we're gonna do that, and then we're gonna go through some stop placement stuff. Where should you be trying to mitigate risk and bring it to break even as quick as possible, but yet not put yourself in harm's way. Um, so that's one of the biggest things that we need to always try to do is just get ourselves in a good spot to where we can be in a trade and not have to really worry about are we going to make money. It's just a matter of how much money are we going to make. That's the ideal spot that we always want to try to be in, and so that's kind of what that'll be. And then also there's two parts to this. These boxes is you've got some over and under setups. You got your normal Bollinger Band setup, right? You would take it back the opposite way, and then you've got stuff that's more like a continuation, and it just offers you a little bit better opportunity to capture on some of the stuff that may have failed. And you're still able to play that same box, but just in a different direction. With same type of risk, right? Same type of risk control, same type of stop placement stuff. And then, we'll go through some of this time frame stuff, how to adjust on, multiple time frames to keep yourself in, uh, the best spot possible in terms of entering a trade. And, there again, it's all about risk. You're mitigating that risk and you're just getting yourself in a better entry is all you're doing. And then again, we go back to the importance of the times to trade and the times not to trade, and why that is so important. Um, but anyhow, what we're looking at here is the NQ, and this is 2 minute chart. I just kind of went over from Friday stuff, some price action stuff, and just to kind of let you guys see um, multiple opportunities that were right here. Which I'll go ahead and delete this so you guys can see from just a bare spot, right? How do we do this? Well, you guys already know. We're looking for price to break this Bollinger Band and then run it and then pull away from it and then make another lower low without actually breaking the Bollinger Band. Well, that's the first part of the setup. And then what we're able to do by doing that is, the candle that actually broke the Bollinger Band is the one that we put our box around, and we only put the box around the body of the candle, right? And the body of the candle is so important because it lets you know where price was immediately rejected from, right? You wouldn't take into account this wick. The only part you would take into account is it went outside that standard deviation, right? And something pushed it back up. Well, that something had to be buyers. Well, they agreed to close that candle right there, right? And then the next one basically just traded up, traded back down, but closed daggum there in the same spot. But then you had a lower low, right? This is a lower low, not a bunch, but it is a lower low. So we would mark that up, our box, right here. And just for illustration, I'm gonna keep my green. What normally folks would have green candles, I'm gonna keep them, similar to this, right? This is we're looking for an up move, so I'm gonna do it with, what would be an up color. Um, and we immediately did it just went right. You didn't get no opportunity. So this box is still valid, right? So anytime, normally what you would see is you'd see price come up here and then maybe come back down, and this Bollinger Band somewhere meet right here for an ideal A plus setup, right? For the rejection off. Well, we didn't get that, right? So this is a situation where you would keep this box up, right? You wouldn't delete this box until it was retested. So if you were going throughout that day, you really had nothing. So just keep right there in mind, right? Okay. Well, just a few minutes later, you had another rejection bar, and it came it came right here just a few minutes later. So you would obviously be looking, are we making a higher high in relation to this body of this candle? And we did. So hey, you need to put your box up here, right? And it's only embodying the actual candle, not, I mean, the body of the candle, not the whole candle. So ideally, right, we always want to look for that A plus setup. That A plus setup is deemed as a rejection, right? And then we come back into this box and we touch the Bollinger Band somewhere in the box, at the bottom of the box, the top of the box, somewhere within the box, right? Just a little bit above it, a little bit below it, a couple of ticks, right? You wouldn't want to go way down here and expect it to work out, or you wouldn't want to go way up here and expect it to work out, because this candle, its wick and its body all mean something. And I'll get to that trade sizing here in just a hot second. But so we're looking for the setup, right? Well, we know the setup's potentially coming. Well, it starts getting further and further away. Well, next thing you know, the Bollinger Band starts to come down. Well, we come back up into that Bollinger Band right at the bottom of that box. Well, that's an A plus short, is what that is, right? And we'll zoom in right here to where you can really see where it punctured the Bollinger Band, right? And into that box. Perfect, perfect, perfect setup. So you would have been trailing. So you would have had short limit orders following this Bollinger Band, right? As soon as it got close to this box, you would start stacking in your orders, right? You would stack in limit sell orders right here. So, and you just keep dragging them with the Bollinger Band, right? Until this thing hit, right? And it would tick you in, right? It would just wick you in, because you would had your orders literally at that Bollinger Band. Well, the very next candle, it falls, right? Well, let's go ahead and size this trade up. So we know, right? We know ahead of time that this was our entry, right? Now, what is at risk? So how do we size into this trade, right? This is the next question that we need to ask ourselves. How do we mitigate risk? All right. Where does our stop need to be? Okay. We could put it right above the box. We could put it right above the candle. Well, two candles later, you would have got wicked out. Yeah. So what you always try to do, and this is the way I play it, that candle that you draw the box off of, right? Get yourself a measuring tool. Whatever that wick is 2.75 points, right? That needs to be your stop. Well, not 2.75. I would probably go 3.25, maybe, just a couple ticks above it, right? So you're risking 3.25 points, right, in this trade. So your stop goes above that wick. Well, I can take 3.25 points on some pretty good size and still be all right, and this is part of nobody knows your risk better than you. So, if you're trading heavily leveraged, you can't probably withstand 3.5 points going against you. You know what I mean? So maybe you need to reduce your risk by either reducing your contract size or just find another setup that has a smaller candle, or a smaller wick, excuse me, which you don't really hardly get much smaller than 3.25 points. But anywho, that's one way to mitigate the risk, right? Is I could stack real heavy on this trade because my risk is small, because I know if I'm wrong, I'm going to be wrong in 3.5 points, right? But my minimal first target's going to always be that 13.75, which is well above, 2-1, right? You always want to shoot for that 2-1. So there you go. That's one way to know entering this trade. All right. Yeah, I'm going to put my stop loss, but I'm going to put my stop loss up here, the initial stop loss. It doesn't stay there. It just goes there at the initial beginning. So that's one way to mitigate the risk there. Let me go ahead and get rid of that guy. right. So we found our risk. We've entered the trade. Okay. Our stop is up here, right? Um, 2 ticks, maybe 2 ticks above the top of that candle, right? So now we need to know, well, where we look like in terms of our position goes. Well, we know we've got an untested box down here, right? Because we already drew it up. Well, we knew we had an untested box right here. So you could literally say, okay, well, I want my target to be right here. And ain't nothing wrong with that. That's a lot more than 13 and a half points, but I would take 13 and a half points and I would probably take the rest off down here, knowing that this was an untested box and this would probably be a pretty good situation for a long. So, let's get a short position added in there here. Okay. So our risk, excuse me, your risk is 4 points. That's what it was. Because we're going from the bottom of the box. We're hit. That's what it was. So we're going to go 4 points is our risk, and we're going to pull down 13.75. That's our first target to sell right here. Right? So let me get this thing squared away here. Yeah. All right. Okay, so we're right here. That's where we entered. Our first target is sitting right here. 13.75 points. Excuse me, right here on this candle. All right. So if you shorted this thing, I don't know, just say you shorted it at I don't say you shorted this thing with 3 contracts. Okay, I guess just make it simple. So your first contract you'd want to sell at 13.75 down here. All right, your next contract you would want to sell would be right here. So you entered here. You're selling your first one right here. Okay. Here's your second one. You were willing to sell right here at this box because you knew this box was coming in, right? So you would sell that one right there. Well, the third one, you would have it as well. But as soon as this target right here got hit, you're taking your stop and you're moving it down here to this 13.75. So you've got 2 filled right here, right? So that's the way your trade would actually look. Now, as far as your stop goes, okay, so I guess hopefully everybody understands that right there, right? You went short. You're willing to sell your first one at 13.75, the next one at a suggested target, which would have been an untested box. Well, it just got tested. There's your third one. As soon as this 13.75 is hit, your stops go from break even down to that first 13.75, which is right here, right? Which would have sold your third one at that 13.75, which still that's about $250, $275. I think that's what that is, but per contract, that ain't too bad. But nonetheless, now let's go back up here to what did we do with our stop? Well, we knew our initial stop was up here, right? That's a heck of a good trade in terms of risk reward goes. You know what I mean? Now, how do you get your stop to break even, right? That's the quickest thing that we need to try to figure out how to do. And the way that we do that, this is all going to be about how quick can you chase this right here? You know what I mean? Because it's up to you to whether you're going to carry this much risk, this whole trade, or you're going to bring your stop to break even. You know what I mean? Like, how quick can you get it to break even? So that's going to be the key. Your entry is going to dictate that. You follow me? So if you have a bad entry, if you can't get your entry at that Bollinger Band, right, you cannot move your stop down here and expect to get not hit. You're going to get ticked out. You're going to get break even, and you're going to watch the trade go with you. That's why it's so important to have that sniper entry, because it allows you to have the least amount of risk and it allows you to carry the least amount of risk, right? But you've got to be so in tune to that Bollinger Band because that's where your order has to go. And I'll show you why. Um, so say for instance, um, you entered here, right? Your initial stop loss is here. Price went down. It come back up, and you had a few points against you. Not much, but you immediately got right back into money, and you had a can. So what you're looking for is you're wanting a candle close. Excuse me, right here. That candle that you entered, the close of that candle, right? You need another candle to close below that candle, right? Okay. So what you're looking for, let me zoom this in. When you get that first rejection off of that thing, all right, you need a candle to close below that candle, right? So it's right here. You follow me? You've got 2, 4, 6, 8, 10, 12 minutes. 12 minutes that you had to sit in this trade before you could move your stock to break even. Okay. So you had the push in there, you had the rejection off of it, and then you're having your roll over. Okay. So as soon as this candle gets closed below, which is right here, your stop goes to break even. Okay. So you would pull your stop down. I ain't gonna let me pull it down. Yeah, it ain't gonna let me pull it down for it to make sense. Well, let me do it this way. I'll just do it with a horizontal line. Probably be the easiest. Okay. We'll say this red line is your stop. Okay. So your initial stop was up here. As soon as this candle right here gets closed below, which it did right there, you bring your stop to break even. Okay. And your stop break even is going to be a couple of ticks below your entry. Do you know what I mean? No need to get it real close because you could probably endure some slippage. You know what I mean? So just cover your tail on the slippage aspect. Keep it a few ticks below it. You know what I mean? You're good. Um, Maybe even a point. You know what I mean? Just don't get it too far stretched out. But so you got to close below that candle, right? And then it come over here and then immediately wicked up, right? And it took most everybody that got involved in this move or got in this move late, it took them out, right? So that's why it's so important for your entry to be so close to that Bollinger Band. Otherwise, you're going to get ticked out. You know what I mean? And if you do get ticked out, you've got to know that you have either A, got to reduce size because your trade is too big if you can't endure that 4-point risk, right? But if you can get that stop move to break even, it's not the matter if you go make money. It's just a matter of how much money you go make. So it's important, so important. You know, that entry is so important. Especially when it comes to mitigating risk and pulling that stop to break even. Okay. And if you can't get your stop to break even comfortably, right? So say for instance, you entered on this candle. Well, it's going to be tough to get in it, right? Because you would have moved your stop to break even down here. Say you got in on, some of this, one of these other candles, you know what I mean? But look at all these wicks that come up here. You would have got stopped out there, for sure stopped out there, stopped out there. It's just you would have missed a whole move. You would have had to keep your stop up here in order to stay in a trade. But that's a ton of risk to take on for that amount of time. So be mindful of all that. You realistically couldn't have pulled your stop down until, your stop would have been up here at break even. And that one right there would have tried to wick you out. But then as soon as you got to this 13.75, you come down here and you put your stop just right above it, right? And sure enough, the next candle come up there and it almost wicked you out. You see? But it didn't. You keep your stop just a little bit above it. And then sure enough, it come down. You got rid of that one. And then obviously the other one you got rid of over here. But that's how you do your stop placement, right? Pretty important stuff. And that's how you kind of trade, you know your size ahead of time as well. That how much risk you want to put on the trade. Okay, so we've played this trade, right? We played this short trade. We knew what to do and how to do it. Okay. You wouldn't have got a whole big runner out of it, but you would have gotten, you know, at least two contracts at 13.75 and one just a little bit more. That's still a pretty good trade. Okay, now granted, okay, so we seen this all play out with an A plus setup, right? So as soon as we see that, take this box and get rid of it because it ain't no good no more, right? It was tested right here with an A plus setup, so it's no good. It's done. now we've got one down here that was untested, right? Well, it become tested down here. Okay. You couldn't have played this obviously both ways because you would have got stopped out on over here. But anyhow, let's just say you didn't get the short. Well, you got an opportunity to get along down here because of this untested box. You follow me? Because you couldn't have played both sides of the market, right? I mean, you would have had to trade M and Q instead of the NQ or whatever. I mean, you could have, but it had to go a roundabout way of doing it. But anywho, so you've got your box here. All right, now you need to adjust. All right, you say, okay, price is coming down the end of this. You're like, okay, well, here's an opportunity. Now, how much size do I need to put on this trade? Well, I don't know. Let's figure out how much size you need to put on it. Just simply take you something and figure out how much it is, because you're going to try to enter at the top of this box on a Bollinger Band poke, right? Well, what is that candle? Okay, that candle is 4.5 points. Okay, now give yourself a couple of ticks. All right, that's 5.25 points. Now, how much size can you use to trade to have a 5.5 or 5.25 point stop? Okay, that's going to tell you how much size you need to put on this trade. Okay, once you figured that out, you know where your initial stop's going to go. Now it's up to you to figure out how good you can be and how quick you can get in this trade and pull that stop to break even, right? So we enter the trade right here. Let me go ahead and get my long position in. So we entered the trade top of the box, the Bollinger Band poke. Nothing wrong with that. We got 4.5. No, we ain't. We got 5.25 points. I think that's what that was. Yeah, 5.25 points of risk, initial risk. So, okay, we know our first target's going up here at 13.75. Okay, we're still good. I mean, obviously, you want to take a trade. It's at least 2-to-1, right? You want 2 parts reward to 1 part risk. Where 2.62. That's pretty good. That's doable. You can be wrong a lot and still make money with that kind of deal. Well, you got long right off this Bollinger Band, right where you're supposed to. Say you done a perfect entry, okay? On the top of the box, Bollinger Band poke, perfect. All right. Your initial risk is 5.25 points. Okay. Your first target is 13.75. Okay. So immediately you see your candle, right? The second candle, once it gets closed above, okay, it got closed above right here. Okay. Your stop goes to break even. All right. Let's pull this thing up. What is this? 27. Okay, that'll work. That'll give us something close to it. Okay. So we'll do the stop placement right here in a minute. Let's actually just run through the trade itself. Okay, so you've entered here. You're selling your first one at 13.75 points. I don't know. That's somewhere right up in here. Probably. Okay. Let's get it right. Let's not guess. Okay. There's your first one. All right. Now your second one, 7.5. Say your risk profile allowed you to trade this trade and not be having your head underwater with 5.5 points of risk or 5.25 points of risk. You could trade this with 3 contracts. You know what I mean? Let's just say that. All right, so you're getting rid of your next one up here. So you've got rid of you've gotten rid of two. Okay, now I can delete this, make it easier. Um, okay, so that's your trade. Now you've got your stop. Remember you remember your stop was down here. Okay. Well, as soon as this closed above this candle, take your stop and move it to your break even, couple ticks above. All right. So you're in this trade before this second contract even got hit. You're in this trade knowing that you're making money, right? You just don't know how much money you're making. Okay. Um, so you would take your third contract. You know what? I told y'all wrong right here. Y'all would have got stopped on both of them because you would have moved your stop to once first targets got hit, you would take your stop and move it a couple ticks behind you, and you would have got stopped out right here. So technically, now you would have actually gotten filled on three right there. That's what would have happened. My bad. So you would have got filled on three at 13.75 points. Okay. Now, if you guys know the Bollinger Band strategy, right? The Momo, the Bollinger Band stuff, well, you got to understand all of this right here is indicative of a new trend, right? Anytime you see this kind of stuff, it's a new trend, right? That's kind of what this whole thing is. It's the first pullback in a new trend. It's ultimately what it is. So you can feel confident if you're in a new trend. I have an opportunity. Yeah, I got filled on all three of my contracts at 13.75 points. Well, if you notice right here, right here, immediately is a Bollinger Band poke, right? Which gives you an indication to buy. You need to buy that poke. Even though you just got stopped out right there, you know that this is the first pullback into a new trend. So you can buy this Bollinger Band poke. Okay. And the way that the Bollinger Band poke works is you buy the Bollinger Band poke and you sell it at the next poke. Okay. That is 104 to 116. That's another 12 points that you would have made on that little bitty trade. And a stop on the Bollinger Band poke is literally, if it pokes the Bollinger Band in a situation like this of a new trend, your stop immediately is only a couple ticks below that Bollinger Band poke because you're buying the Bollinger Band. So put it down here, right? That's the idea. And you sell it up here, obviously. So that's how that trade would have worked out. Now, if you want to open up your risk, you could have got filled on both of these at 27.5, right? You could have. But you knew that your stop had to be down here still at break even, right? So, but if you guys notice the way that I trade a lot, you'll see me getting hit with these kinds of trades because I'm just trying to keep y'all in a good spot and at least give y'all the understanding of how can y'all at least get this 13.75, you know what I mean, on a couple of contracts, whatever, at least one of them, and hopefully two of them get filled at 13.75, you know what I mean? And, you can get in a situation like this that mitigates risk and get filled on something like that, and get you another 12 points or whatever. But lots of times you'll see me get down here that my initial risk already. Well, I pull that stop to break even just a little bit above it, and you'll see me get filled on maybe like a block of three or a couple blocks of three right here. And then you'll see me get filled on a couple blocks of three up here to move like this, or this thing will come back and just take me out at break even. So I got rid of one block, and most of my position I got hit for a break even. You know what I mean? Just kind of, you'll see that a lot with my trading. But I'm just letting you know there's multiple ways you can play this, but that's, that's entirely up to you. However you wanted to play it, you could took them right here, or you could just, be ballsy, I guess, and read price action and take it up here. It's up to you. Like that's how you can play that. But once you see something like that right there, you need to go ahead and get rid of that box because it's no longer deemed untested. It is indeed tested. Um, so you get rid of that box. You have no need for it no more. Um, and then, we re-rolled into the end of the day. So that kind of covers, you know, a long setup, an untested setup, um, or a short setup and an untested setup. And be mindful, guys, that you always want to try to look for that A plus setup. And because it gives you the least amount of risk and allows you to pull that stop to break even as quick as possible. But if you can't get that stop, if you did not nail your entry, you have to assume that you've got to take on that full risk, at least to that first 13.75 level has been hit. You know what I mean? Because otherwise, let's just be honest with ourselves. You could literally enter this trade, I don't care, anywhere in this price range. Say you entered it from right here to right here. And you could throw a horizontal line in here, and I guarantee you would have been stopped out. You know what I mean? Because it's designed to take you out. I mean, there's every single tick inside from here to here has gotten hit at least 4 or 5 times within this move. You know what I mean? If you just went down some time frames, you would see that. You know what I mean? Like it's just, well, hell, let's just do it. Don't take my word on it. I don't know. I'm just going to take this thing and I'm just going to drop it anywhere. 1, 2, 3, drop. Okay. I dropped it right there. Now let's go down some time frames and see how many times that thing got hit. You know what I mean? Just look at that thing. Look how many times it got hit. And it was just on another chart, it didn't show that, but that's how many times it would have got hit on a 36 chart. There is absolutely nothing safe inside of that zone, right? You have places to buy and you have places to sell. You have very limited places to buy and very limited places to sell. If you've entered anywhere through here, right, you got to know you're not safe. Your stop has got to be extremely wide in order for you to have any points. And that thing could reverse on you at any time. And that's why so many people get their ass kicked. It's because they don't know where to trade. You know, they just trade. If they see something, they just trade it. And then the next thing you know, well, it didn't turn out good for nobody because they either got stopped out trying to be mindful of risk, but not understanding. Well, it wasn't that the trade was bad. You just had the wrong time to be trading. You know, simple as that. So, a lot of what we've do to ourselves is our own self kicking our own ass, and we don't realize it until later on. But seeing something like that right there on, just say even a couple minute chart, you got to know, you got to know on a move like this, you could have shorted it up here, but you would have had to short it at the absolute best spot and had your stop up here if you didn't get the absolute best spot in order just to capture this move. Otherwise, if you had pulled your stop in to anywhere up in here, you would have gotten stopped out and you wouldn't have made anything. You would have either broke even or lost money, and it would have been a break even at best. So that's one thing to be mindful of. Just pay attention where to trade. It's not so much as how to trade, it's where and when to trade. That'll save you a lot of time, that'll save you a lot of headache, and it'll save you a lot of money too. For sure. And I guess the next thing we'll go over here is just we've got this thing, it's kind of like an over and under setup. And what it does is you get in a situation. It's harder to see on a bigger time frame. Because it don't happen as much, right, on a bigger time frame. But lots of times, like, you find yourself looking at, 1 5-minute chart or whatever, doing this setup. But if you're on a 1 minute chart and you see a setup, well, go down to a 30-minute chart, cut it in half, or 30-second chart, and cut it in half, and you're liable to find yourself some pretty good setups, at a better spot. Um, so something like this right here, we know this is somewhat of an over and under setup. Well, we knew right here we should have had a short setup, right? We should have had something that told us, okay, well, we poke through. Let me lock this so it won't move on me. So we poke through and we fell through. So we should have been looking for a short setup into here, right? But if you notice, this daggum band started contracting right here, right into the box. Well, when you see that, you got to say to yourself, okay, well, it's pretty doubtful that we're just going to fall, right? Because I mean, this thing, the idea of it, right, is it's capturing 95 to 98% of the price, roughly. So you wouldn't expect it to fall down here and then come back, you know what I'm saying, to give you room to take that trade. So you got to understand that, right? And we didn't actually get a pull below and then back into the box. You know what I mean? It didn't happen. So you would have to say, okay, well, this most likely is going to be a failed short setup. And that's what it looks like. It's a failed short setup. And it sure enough was. Well, what you want to see is you want to see price actually get above that box, right? And it's the same concept, guys. Your risk, okay? You've seen price get above that box, and it actually went above the box, come back into the box. Okay, when it's coming back into the box, obviously you want to see an A plus setup. Well, you didn't get your A plus setup, right? You got an A setup, which is the Bollinger Band didn't get poked, which A is still pretty good, but you got to know your risk, right? Always know your risk. So if you wanted to take this long on a failed short setup, well, there again, what's your risk? Well, your risk is the box plus, let me get a long position here. So the box, if you're entering on top of the box, just like an A plus setup or an A setup would, you've got to account, okay, well, what is the wick of this candle? Okay, now go a couple ticks below it. All right. So the wick of the candle from the top of the box is 2.75 points. Okay, so pull it down a couple ticks. All right, you're at 3.25 points. Now you got to say to yourself, okay, well, I'm risking 3.25 points. How much can I trade? Can I trade 1, 2, 3, 4, 5 contracts? I don't know. That's up to you. Nobody knows your risk better than you do. So keep that in mind. That's your initial risk. So that's what you're going to have to risk. Okay. All right. Now, when I'm trading on a 30-second chart, I'm being mindful of how low of a time frame I'm on. So I take my 13.75 points and I always cut that thing in half. So it's 6.5 points on a 30-second chart. If I'm looking at a 30-second chart, finding setups on a 30-second chart and executing on a 30-second chart, my targets will be 6.5 points. So you got to be mindful of that, right? Your risk is often smaller, but yet your reward is smaller as well. Okay. So you pull up your 6.5 points and you got filled right there on 6.5 points immediately, right? So your stop was here. So once you got okay, let's go back through this again. Oh, your entry was here. Your target was right there. Okay. That's your 6.5 points. Now, when could you have pulled your stop to break even? Remember what I said, the second candle, you need to close above it. All right. So I'm going to delete this guy because you didn't get another 6.5 point. Well, yeah, I guess you did, didn't you? Yeah, you would have got paid pretty good on this trade. Holy smokes. I didn't realize that. All right. So, yeah, let's just run this thing down. Okay. Hold on a minute. Let me get this thing. I'm going to have to get the calculator out and get this thing added up. I didn't realize it was paying that well. So we'll just go 6.5. So let's go 13. I don't know. Let's just say you could go 3 contracts deep, right? I mean, I guess that's what we'll do. Um, so there's your second target. 19.5. Here's your third target. Right at the top of that thing. Okay. And I don't know if you got paid on the fourth one or not. You might have. 26. Hmm. You might have. Boy, it'd been ballsy, but you might have. I mean, right at the tick top of that thing. Wow. Okay. All right. So you would have got filled on all three or four. Ever how many you could trade, I guess, right there, right? So you knew you risk. You're risking 3 points and potentially making 26 points, right? You don't know that you was going to make 26 points, but you just kept moving your 6.5 point levels up until it just stopped, right? And that's where it stopped. Now, where do you say you traded this thing with 5 contracts? Or let's just say you traded it with 3. It doesn't matter. If you traded it at 3, you got paid right here. You know what I mean? And you're done. You watched it run again. You watched it keep on running. But you knew, all right. Well, my account said I could only risk 3 contracts with this amount of risk ahead of it. So you knew, all right. Well, if the 3's all I can make, well, ain't nothing wrong with that. That's a pretty stinking good trade, especially on a 30-second chart. But nonetheless, you say you traded with a 5, okay? You've got 1 contract extra here that you need to do something with. Now, again, I'm gonna move this. I'm gonna get rid of this thing so it's easier to see. Now, how would we run our stops, and how would we place our stops? Well, you knew your initial risk was right here. That's your stop. Entries here, stops your red line. So you would look for this candle to get closed above, and it was this candle that closed above it. Okay, so take that stop and move it to break even. Okay, and there again, a break even to me is a couple points, a point, couple ticks, whatever your normal slippage is. That's how far it needs to be above you, right? So where you're not actually losing anything. You're covering your commissions and you're adjusted for slippage, right? So to me, I have to go a couple ticks above. You know what I mean? Just to cover it, because you never know what happens when it gets back down in here. Well, yeah. So if you would have took the idea of you got paid on the first one, take all these stops and move them a couple ticks below, right? Well, if you done that, you would have got stopped out on all of them. You know what I mean? At that 13.75, whatever. So you would have gotten kind of hit. Okay, so if you would have kept your stop down here at break even, now you've got to understand the risk right here, right? This thing did not have to go right back up. It could have come down here. You would have got filled on one, and it would have come down here, and it would have smacked you on the rest of your contracts. Happens to me every damn day. But yeah, it's a choice that I make. I could have, knowing when it does happen, I look at this and I'm like, daggum, I could have got, I could have got, I could have got all of them filled up here, rather than just one. But, I mean, it's them times where, you see stuff like this and you're like, holy smokes, boy, I sure am glad that I didn't kill them all right here and watch it keep it running like that. That's hard to swallow. So, that's why I choose to do this. But I mean, I'm just saying you don't have to, if you're good with 6.5 points on a 30-second chart 5 times, then hey, so be it. That's pretty good. Yeah, I ain't nothing wrong with that. But anyhow, this is how you could manage your trade to get more out of your trade. Pull your stop to break even. You knew when to do it. All right. So now you're in this position, right? You've gotten paid on one. Now you're in a position of, okay, you're not in a position of making money. It's how much money can you make, right? You've made some. So you can afford to sit in this thing for a minute. And that's why I always take that one off right there, because I pay for my trade. I pay for me to be able to look at this and not know that, hey, this ain't just just an opportunity cost, right? This is undoubtedly an opportunity. You know what I mean? So that's the way I look at that. So we know we've got one contract left over. Now, where could we have slid this thing up in terms of a stop goes to keep us safe? Well, your first one got filled here. Your second one got filled here. Third one got filled there. Just take this thing and pull it behind it, right? So first one got here. So say your second one got filled right there. All right. Say you pulled your stop up here to this lower high or higher low, excuse me. All right. The next higher low that you see, just when this next target got hit, just pull it up there to the next lower high or higher low, excuse me. All right. And just keep doing that all the way up the trade. Okay. All the way up the trade. And then by the time that as soon as this last one got filled, this is where you would have pulled your stop, right? It made that higher low. Okay. So your fifth contract, if you were trading this with 5, if you could have afforded that amount of risk, right? That's the only way you can say, okay, I can afford to trade 5, right? You've got to know that initial risk first. Okay. Say you was trading 5. I didn't match the right one here. Okay. Well, there you go. There is your fifth one that got filled over here. Now, that's a pretty sporty trade on a 30-second chart. You know what I mean? I don't really care who you are. It don't hardly get much better than that. But that's how you can maintain that trade and stay in that trade. You know, not everybody, like I said, is going to be okay with watching, pulling this thing to break even as quick as you can, which I don't care who you are. I think everybody ought to do that. Just because you never know what can happen. A damn missile could drop in the Middle East and, it could be right before you're about to pull your stop to break even. And if you just didn't do it, you wished you would have, you know what I mean? That's all it takes, so get that thing to break even, man. It ain't gonna hurt nothing. As you've seen right here, if you can identify your entry good enough, then okay, I can pull my stop to break even, and I'm gonna save myself a lot of dinero. Later on down the road, if you do it 1,000 times, you'll save a lot of money by doing that. But if not, you need to size appropriately. If your entry sucked, I hate to say it that way, but if it does, you need to keep your stop down here until that first one has been hit. But you knew where you should have entered. So take that stop and just move it up here to where you should have entered. You know what I mean? And maybe that'll entice you to do a little better job on your entry the next go around. Little constructive criticism. It happens to me all the time too, man. I just miss it, and if I miss it, that's the way I play it. Once that first one's hit, I'll go ahead and take that stop and move it to break even like that real quick. And, or not really my break even, because my break even's probably up there, but, probably right where that pullback come and kick me out before it run. That's typically the way it works. But, move that thing up here where it should have been, on a really good entry. And it just means that if trade does go against you, you lost a lot less than this initial amount. That's the way I'd play it. Let's see here. And there again, guys, just the thing about these time frames is, so for instance, if you're trading every day, I don't know. So if you've seen, excuse me, and by the way, let me go back to this real quick. So if you've seen this over and under setup right here, even though this was a failed short setup, right? It become a long setup, right? By doing the over under type deal. Same scenario. It's just flipped on its head, right? It was a failed short setup, so you'd use it for a long opportunity. But once you see that setup take place, delete it. The box is done. You no longer have business in that box. It's done, right? Just delete it off your chart. There's no need to looking at it anymore. Only keep the ones that have been untested. That's it. Until they become tested, keep them on your chart, and be pretty consistent with it. So if you're flipping through, 30-second, 1-minute charts, well, if you've got just a a bukus of boxes on a 30-second chart. Don't go to a 5-minute chart and try to play them. You know what I mean? It ain't gonna work. That's why if you notice me, I pretty much stay on a 5-minute, and a 1 minute or a 30-second. And typically if you see me on a 30-second chart, it ain't because I'm sitting here trying to look for an opportunity on a 30-second chart. It's because I seen a setup on the 1-minute chart and I'm trying to get a better entry on a 30-second chart. You follow me? Or if I see a 5-minute chart, I see a setup on a 5-minute chart like this one right here. This looks like maybe right, you know what I mean? Like at open, it looks like it could be trying to set up for an opportunity, right? Um, and there again, I color code my boxes for whatever it is. So if it's a short, obviously I do it purple, indicating something down. If it's green or teal, in my case, I'll do the box in teal. But say for instance, we see the opportunity for a short. Now, granted, there's a lot of things that's got to happen for this short to come in handy. So let's just think about this for a second. How could this play out? This is something that ain't happened yet, right? So I see this on a 5-minute chart, and I'm thinking, all right, well, how can I get a better entry? How can I make my entry the best that I can possibly do? Well, I'll just go down to a 1-minute chart. Okay. And once I go to a 1-minute chart, I'll start looking at this thing. How can I have made this the best trade that I possibly can make? Well, do I see a setup on a 1-minute chart? And I'm sitting here looking and I'm looking and I'm looking, and I can't see nothing, right? I see something that's potentially there, right? It would have been something that looked just like this. Well, this shows me that the setup's already taken place. You know what I mean? Let me delete that box because that was a 5-minute setup. On a 1-minute chart, it's showing me there was a setup. Okay? Because we got the higher high and we pulled off the Bollinger Band a little bit. Well, in order for this thing to be an A+ setup, it should have actually entered on this particular candle, right? At 127.5. Okay? Well, take into account, guys, where we are. Okay? This was the end of the day. This was late in the day. You got to understand something. All right? 3, 6, 9, 12, and 3. Those rotation hours are highly, highly important. Just because you see something like this, right? And you see it on a 5-minute chart and you see it on a 1-minute chart. That does not mean this is the trade to take. You really need to focus, really, really, really need to focus on those rotation times, because those rotation times are going to give you the best signal. Okay? Now, I'm not saying that this won't happen. I'm not saying that this won't come down. And so let's just play it out for a short scenario, right? Price will need to come down. It need to come back up. Okay? Well, on that, this Bollinger Band would need to contract somewhere like this right here. You follow me? Your short position would need to be somewhere like that. Okay? And this lower Bollinger Band, boy, I messed that up pretty bad. This lower Bollinger Band would need to do something like this right here. Okay? Well, you would know right there would be the opportunity. Yeah, right here would be your opportunity. Say, how could I possibly mitigate your risk? Okay, well, how could you mitigate this risk? You got to know ahead of time, this is a short position. If your entry is going to be right here, you got to know, okay, the top of that wick is 5.75 points. Go a couple ticks above it. That's 6.5 points. Now, that's how much your initial risk is. Okay. Granted, your first target's at 13.75. So you're at perfect 2-to-1 is what you are. Well, right at 2-to-1, whatever. So anyhow, that's what you would kind of look like with with your first target potentially being right here. Say price did go down. That'd be your first target. Okay. So that's how you would play that potential short setup that you're about to see right here. Okay. Um, but keep in mind, this is not a rotation hour. So this may fail completely. You know what I mean? You're going to have more odds of something like this holding up at a rotation hour. Okay. Um, so that's kind of what I was trying to drill home with to you was just because you see the setup, it needs to really match up with that rotation hour because that rotation hour is going to put as many things in your favor as possible. Now, let's just say, for whatever reason, this becomes an over under, a failed short setup, right? I mean, this looks to be a short setup, which 100% is a short setup, but say it failed. How does it fail? It fails something like this right here. You know, you see some Bollinger Bands start to contract. Um, Let me move this thing out of the way. And what you'd do is you'd see price do something like this right here. Run up here, run down, come up here, and then probably do something like this right here. You know what I mean? Inside this box. It could do something. That would be your entry, right? You would see a rejection somewhere right in here, and it would start to come off. Okay. Now, how do you play that? There again, you got to, back to what we said. Granted, these are all hypothetical things here because none of this has happened yet. But it's just going to go show you how do I approach risk, right? Because there's, if we just be honest with ourselves, when we're trading, like literally the profits are a byproduct of our risk. Because if you don't know how to control risk and you don't know how to put yourself in the market, well, your profit is going to get eaten up by your stop because you just didn't know where to put it, right? So your risk gain realistically needs to be better than your profit gain. You know what I mean? Like that's how you get your profits is through your risk management. So that's why it's so important. So we know we've got a failed short set up here potentially, right? Again, hypothetical. So we know we want to enter on the top of that box. Ideally, if you could get to the A plus setup, right, the Bollinger Band poke, that would be beautiful. But if you didn't, it's okay. That's just an A setup. Ain't nothing wrong with it. Well, you need to know your risk. Your risk is going to be from the top of the box to you see the bottom of the candle, right? It's 2.5 points. So let's move it down to 3. That gives you a couple ticks below it. Ain't nothing wrong with that. That ought to do pretty good. But that's your risk. So, minimally, we're on a 5-minute chart, so you're pulling it up 1375. That's pretty good risk reward. You know what I mean? Like, I don't know what you've got to do to your account, but I mean, I don't know how much, you can allocate to an account, but if you're only risking 3 and, you're potentially making 13.75, that's a pretty good deal, in my book. I'd be willing to throw a lot of, personally, I can't speak for everybody. There again, nobody knows you on risk but you. But keep in mind that's going to determine how big a size that you can trade this trade with. What is your risk? What is your initial risk? Because that's what it needs to be. It needs to be defined. And if you can't nail your entry, then this risk reward trade gets a little crappier. You know what I mean? So you got to understand that. All right. Well, if my entry was up here, man, whoosh, maybe I can't swing a ton. You know what I mean? Maybe I need to back off my sizing. And all that does is just keep you in the game longer. You know what I mean? Like gives you the more opportunity to just go to bat and actually be able to knock a ball off cover one of these days and just being able to be putting yourself in that same position over and over and over and not really take some big hits along the way. That's kind of the way that'd be approached. And then there again, we went through the whole stop placement. How do you move your stop up? When should you move your stop up? And a lot of it's based upon your entry. So, keep that in mind. Not every stop's going to be the same and not every entry is going to be the same. So the better you get at that, the better you'll be able to trade and the more money you'll make and the less money you're likely to lose by your entry. It's all about location for sure. Um, and there again, guys, just remember that whole 3, 6, 9, and 12. let's go back to something real quick. I'm gonna keep that box up because that box means something. So if y'all, yeah, let's look at this right here. So we knew we had a. This would be something that's pretty interesting. We knew our short setup right here, um, and we knew our long setup down here. Okay, and this is going to fit right into that 3 o'clock rotation thing, right? So we know that we've got a rotation at 3, 6, 9, 12, and 3. That's Eastern Standard Time. But, it don't have to happen on the nose at 12 o'clock. You know what I mean? It can be just a little bit behind it. It could be a little bit in front of it. But somewhere in that time, it's going to have some type of rotation. And that rotation is usually paired inside of one of these setups, right? This Bollinger Band setups. You didn't get it at 12 o'clock. Well, that's okay. Ain't nothing wrong with that. But I'm just saying you didn't get it. Well, you just follow it until you did, just a little bit behind it. Really about 38 minutes behind it. As long as it ain't happening over here around, 3 o'clock or whatever. I mean, 2 o'clock, you should be good. But sometimes you do. Um, but there again, look for those rotation times. That's pretty important. Um, so you missed your long opportunity. You knew that. Ain't nothing wrong with that. But it set up around 12 o'clock, you know? Well, when could you have executed this long? Well, if you look over here, so you got 12, um, 13, 14, 15. So if you're looking over here around 15 for a next potential rotation, well, you knew when you come back down into this box, you said, okay, well, there's our rotation time. You know what I mean? It's time to rotate. And sure as shit enough, that's exactly what it did. Just a little bit ahead of it, right? But this is the part that I'm telling you. If it don't set up at 12, the 12 o'clock setup may be the 3 o'clock execution. You know what I mean? Or maybe just say that 12 o'clock didn't set up. Or maybe say 9 o'clock setup was 12 o'clock's execution. It happens like that. You know what I mean? Like it'll be a split in between the two time rotations, and ain't nothing wrong with it. But that's just kind of how you can play it. Two different rotations, you know what I mean? But yet the same idea, being that you had an untested level, come down in it right at that rotation time. You could, that just puts more confidence in maybe, at, on your long here that it's probably going to work in your favor. Anytime you can line anything up with some rotation, it's going to be good for you. It ain't going to hurt you, that's for sure. Unless you're just on the wrong side of it. Now, if you're just trying to short down here late in the game, yeah, that'd probably suck for you. But, and then, there again, back to the whole volume thing, and some of that combine killer strategy stuff, you've seen some late sellers showed up, you know what I mean? Like in terms of relative terms down here, that would give you a little bit more confirmation. Some of you guys that followed it, but we box right here and you seen some sales coming in, late sales down into this move. Well, that's a hell of a good indication that, things is about to change. And especially granted that rotation time, man, that just puts some fuel to the fire. That's one way of looking at that stuff. Just kind of combining all of it together, right? And just paints you a little better picture. But there again, guys, it's one of them deals where it just puts us in a good spot to make these trades. You just ain't making them to make them at any given time during the day because you just seen how you could have got absolutely whacked anywhere through this move. It's not like you were wrong about the move. It was you were wrong about your timing and where would you had to put your stop to be safe. You know what I mean? Like it's location. It's not that you were wrong. It's just you were late to the party and you're going to pay for it. If you want to try to be still mindful of your risk management, you can't be mindful of risk management right here. It just don't work. You just get stopped out, and you watch trades go, you watch trades stop you out and then they go in your favor. And you're like, well, why in the heck did they do that? Well, there you go. That's exactly why they do that. Your opportunity was up here, not somewhere in here, in this little zone right here, this is where you kick your own ass, It's not them kicking your ass; it's you kicking your own ass because you didn't recognize it up here. Um, it took me a long time to understand that because I was that person, you know. Um, but that's it. It's absolutely how it works. Uh, well, guys, I mean, I guess we'll open this thing up to some conversation. If anybody's got anything that they want to say or ask, and let's bring it on, man.
Yeah, Mag, I got a question.
Well, yeah.
The setup that you're looking at right there at 245. So with the confluence of the rotation hour and the untested box,
Mhm.
even though the price is riding down the band like that, you're still confident in putting the limit order at the box, even though you're kind of stepping in front of a train.
Absolutely. Yeah. I mean, I've got confluence in multiple degrees, right? Back what I was telling you. Let's throw that box back up so we can go over the exact example. So I know it's not like I have a ton of risk. Now, if this box was to be, say this box was 10 points, I'd probably have a different outlook on it. You know what I mean? Because my risk is so huge. You know what I mean? Like I would have to put on very little size to take 10 points of drawdown. You know what I mean? Um, so knowing this risk, that's number one that puts me in a trade because I can be wrong a bunch with this kind of a setup and still be good. So we're we can pay attention to volume, especially anybody that went through some of that combine killer stuff because it's highly relevant, right? You knew to your left, volume was increasing as it was coming down, which indicates late sales, right? People who didn't realize this was a short until it started really getting pretty wild, somewhere down here. And they're like, oh, snap, man, I need to get on this thing short only for this to rip in their face. You know what I mean? That's how it happens. And, knowing that this untestable level was here, you just had your limit sitting down here, you know? And what a beautiful thing it was, because your risk was small, your volume was indicating it, and you had an untested box. And bada bing, bada boom.
All right, I got you.
Yeah.
So the amount of times it works versus the times it doesn't, especially with that confluence, that's what gives you the confidence.
Oh, absolutely. Yeah. Now let's just say that this candle was that big, right? Now we're gonna be talking about something totally different. It's like, okay, well, hell, I ain't putting but one contract on right here. You know what I mean? It's not saying that the setup wouldn't work. It's just, hey, am I willing to eat 20 points of risk? Like I probably wouldn't even take that trade, quite frankly, even with one contract, just because it don't make no sense, especially given that my first target is 13.75. You know what I mean? It has to fit in your risk reward setup, and it has to fit in your risk profile, for this kind of trade to work out.
So in that scenario, say the box was 3-4 points, but the wick was, that extra 8 below it, that would still be something that you might not be as interested in.
Yeah, because I mean, there again, I'm always interested in a 2-to-1 or better. If it doesn't fit in that 2-to-1, man, there's so many opportunities in this thing. Just pass. It's not worth it.
All right, I appreciate it.
Hey, no problem.
Hey, I got a question for you, if you don't mind. The original short box that you had up there, I don't know if you can put that one back on or not.
Get her up here.
Yeah, that's the guy.
Yep. Okay.
All right. So maybe I missed it because I joined a few moments late. Okay. So when you drew your box and then you had price come below the box and then come back up through it, and now it's made the higher high that you were looking for without breaching the Bollinger Band. Like, wouldn't you want to get into this short, because now you've come back out of the box after that, you have a candle completely closed out of it, and then you come back up and test it. And is that not considered a good entry point for a short?
I mean, it is. There again, you're basically entering the same spot here as you would have over there on the A+ setup. It's just that was an A setup, not having that Bollinger Band rejection, but you were still having that box rejection. You know what I mean? It's,
Yeah.
that's, I guess you would consider that more of like a doji. You know what I mean? It's not really a doji, but it's indecision, but in a nutshell, right?
Yeah.
Obviously more sellers stepped in than buyers. From the top, I guess is the best way to explain that. So if you were going to do that, just know your stop needs to be up here. The same stop placement, right? There's nothing that says you couldn't do that, but let's look at the volume and see what the volume was kind of showing on this thing. Well, when
But
you had volume, we had
so
volume coming in at the top, late buyers.
Yeah.
It only makes sense for price to run it against them, and try to trap some of these guys that were late. Ain't nothing wrong with that, man. That would fit right into the criteria of the combine killer. You know what I mean? The risk is small. It's well outside the bottom of the box. Come back in and reject it, and
okay.
there you
So
go.
for you to kind of put the A plus brand on it, it needs to come back and actually poke that Bollinger Band again in that same box. That's what really makes it sweet, right? That's okay.
That's where that's where you usually get your hardest rejection come from. Like that's where the move actually starts. Like,
right.
Yeah, it rejected right here. There's nothing that, I mean, that's money right there, man. That's money to be made. But it kind of shot right back up. But then the real rejection happened at that Bollinger Band. As soon as it poked it, it just kind of, fell off. But you'll see that a lot, these kinds of scenarios where it just really falls off after that Bollinger Band poke.
Now, do you tend to stay on the 2 versus the 1, or is it just kind of depends on the day? Like you said, popping back and forth and
yeah, man, I'm just finding trades on any time frame really, but typically you'll find me on an hour chart with some bigger levels, a 5-minute chart or a 1-minute chart. But if I'm on a 5-minute chart, I'm looking at a 2 and 1-minute chart to find some really good entries on that 5-minute chart. Or if I'm on a 1-minute chart, I'm looking at a 15, maybe a 15-second sometimes, but a 30-second chart to find some really good entries. Type stuff.
Gotcha.
But I don't, I'm normally not working upward, so I'm not like, if I'm in a trade, say I'm on a trade on a 2-minute chart, right? And maybe I was looking for a really good entry right here on a 2-minute chart. Well, I wouldn't go from a 2-minute chart to a 5-minute chart and try to maintain this trade. You know what I mean? I would only stay on that 2-minute chart to maintain my trade. The only thing I would use a smaller time frame for would just be to simply entry. You know what I mean? Just to try to really nail that entry.
Nice. Yeah, makes sense.
Hey Magnum, this is Shimmy. If I could ask you a question, I'm just curious. I don't know how long you've been trading the system, but do you have an idea of like what the win rate is? I'm just trying to get an idea of whether this is like a high win rate system, or it's like a system where you win 50% of the time, but it has a good risk to reward ratio and you come out on top anyways.
To be honest with you, man, I forward test everything. So, I mean, I'm currently at 70, 80, 90% days, sometimes 100% days.
Wow.
Yeah, if I have some bad days, it's usually because I misread the market, simply as that. But the strategy itself, man, is pretty solid.
Very cool. The second question I had was just conceptually, I was trying to understand. Some of the other guys told me that the higher highs and the lower lows that we're looking for are relative to the closes, right? Close of the poking candle relative to the close of the higher high or lower low candle. And I was just curious, you may have explained this before, and if so, I apologize, but why is it that we look at the close as opposed to just the pure high, like the high of the wick or whatever it is?
Yeah. But so in context, right, we're looking at these bars, and these bars, obviously that's an open, that's a, you know how to read a candlestick. You got your high, low, close, open, high, low, and close. Okay. So the reason we look at the open is because there was buyers and sellers agreed to open that price right there, right? They agreed to close that price right there. Okay. Well, say this bar, let me delete this box real quick, make this easier on us. But this was a setup, right? So you had the price open right here, and it traded all the way up to the top of that wick. Well, there was somebody up here that sold the heck out of that thing in order to push it back down, which created that wick, right?
Right.
So this is where they agreed that it was fair price on this candle, right? And you see where it opened up on the next candle. Well, it got pushed back down. So the open and the close are the most important parts on any candlestick, right? Because it's an agreed price where they're going to open it, and it's agreed price where they're going to close it. This is nothing more than an excess of sellers in the market, right? Okay. So that just lets you know the attitude of the candlestick, right? It lets you know the attitude of the market. You know, there was way more sellers stepped in than they were buyers, which obviously reason being they closed the candle way less than 50% of this candlestick.
Right.
So and it's just a mere reading of price action. That's all that is. And so when you look for this, right? And especially when it's on the outside of a Bollinger Band like this, because this is a 2.21 standard deviation Bollinger Band. So if you see price even get on the outside of this Bollinger Band, you've got to know that this area is supposed to capture anywhere from 90 to who really knows the number, but if you just look at it from an overall perspective, it's at least 95% of the price. You know what I mean?
I think a 2.21 standard deviation is probably about 97 to 98% of price action.
So if you see price go outside of that, you got to know that that is an extreme of some degree. You know what I mean? So that's a spot that you take attention to. And it's not so much as this little spot that you take attention to, it's the body of the candle where they agreed to close this thing, right? That's why I only ever capture the body. And it gives me definition, you know, and I don't know, they might be somebody smarter than me that actually says, okay, well, you know, maybe you could just use this as a box, you know, versus this as a box, you know. I've always used the candle of the, you know, the body of the candle. And it's just the way I do it. I'm not saying it's right and I'm not saying it's wrong, but that's just the way I do it.
Hey, it works.
Yeah, I mean, it works, you know, but and then obviously I'm looking for that higher high because, you know, price has agreed that, you know, it's kind of one of them deals like if you a lower momentum indicator, right? It creates a divergence. You know what I mean? And this, if you was to look at this on any momentum indicator, like a lower momentum indicator, you know, this would show you, even though this was a higher high in price, this was
a lower high.
Yeah, it's going to be a lower high because, you know, that 97%, you know, price range, you know, price is supposed to be inside this 97% of it. Well, it wasn't right here, but it definitely was right here. So even though it was a higher high, and these are agreed upon prices, you know what I mean? These closes, you know. So that's how that come to be. Why it's more important, the closes and opens versus the wicks.
And just a follow up to, I think, the previous guy's question about resting orders, like limit orders. Do you only do resting limit orders, or do you sometimes wait for a confirmation, like a rejection off the box?
No, I mean, I'm following that Bollinger Band. You know what I mean?
Okay.
I've already got my box mapped out, you know, well in advance. You know what I'm saying? Like I've already got my orders set. So, you know, I know what I'm willing to risk already. So it's not like I'm going into this thing hot and blind. You know, it's all predefined. You know what I mean? And all I'm doing is just sliding my orders along with Bollinger Band. And granted, man, we got to be realistic with ourselves. Are we gonna get this right here? This 11.6, you know, 15,000 11.16 fill? It's doubtful. You know what I mean? Like if you did, I would say you're lucky. You know, you're probably going to get like an 11.1550, 11.1575 if you're really being, you know, as good as you can be. So that's, you know, just it don't have to be absolutely perfect, but it's got to be close to just to be able to get yourself in a spot where your stops are safe and you can get in that spot where you can get your stops moved to break even, you know, as fast as possible.
Right.
Yep.
If you could entertain one more question, I was just curious. I know the NQ has been a little bit more low volatile in the
Mhm.
last few months, and like before the summer, it was much more volatile. And I was just curious if like how the system adjusts, or if you would take different types of trades or something like that when it gets into high volatility and the stops are no longer, 4 points or 5 points, right? On the NQ, you get
Yeah.
to like 15, 20 points, a few months ago, I would say.
Yeah.
And you would just say it's up to the individual to determine risk, or you would say like 15, 20 points is too much because then we're hoping for like 40, 50 points for a 2-to-1 ratio or something like that.
Yeah, I mean it needs to fit your risk profile. At the end of the day, like my risk is going to be different than yours, and yours is going to be different than somebody else's. It's just we all are different in that degree. Um, but as far as markets, I've tried this thing on gold. I've tried it on crude. I've tried it on silver. I currently am in Bitcoin right now off of a setup. So, you know, I don't know if it gets any more volatile than Bitcoin. Like
Right, right.
it's pretty wild. So, and it works really good in calm markets. Something like the YM, the RTY, it works really good. Something that's real smooth. Um, the ES,
Yeah,
I
I
don't.
trade the RTY. It looks real nice on it.
Yeah, I don't know what's up with the ES as of late, man. I've gotten um, little bothered with that thing, but I caught this whole move right here on the RTY the other day, and it was simply off of that little bitty tiny setup, right? I mean, knowing this setup, right? It come back into it and just dumped. And then I think we had another one. I don't know why this box is over here.
Can
It
I
might
kind
be.
of,
Sorry.
can I add to that? You said you caught that whole move. How do you know when to get out of something like that? For me, I mean, I look at the P&L, I'm like, oh, I'm up $300 and I take the profits. What gives you like the clarity to stay in a trade for that long?
So, if there again, if you see the setup trying to start happening on the same time frame, say you got short up into here,
Mhm.
and you're just following this price down, you're following this price down. Well, when you see this thing start pulling back, right, and you see this thing start making lower lows without coming through this Bollinger Band, it's a good time to bail. You know what I mean? Like this, because this is setting up for a potential long. You know what I mean? What we're looking for in long terms.
Okay.
Um, so
So as
that's
long
that. Go ahead.
as stay in it,
Do what now?
as long as it's riding on the band there, just stay in it.
Just keep a hammering, man. There's nothing. I mean, there's nothing that says that you need to sell this thing, and especially if you're on like a 5 minute chart, just go back through price, and find some areas. Let's look right here. Well, heck, here's a good. That might be one I had that daggum box up. If you don't know the truth, let me look right here. Well, this thing ought to have been that color anyhow. So there was a setup, right? A long setup.
Right.
And we never regularly actually tested this thing. So this is deemed as an untested level. So realistically, the RTY should be coming down here and potentially testing this. And look right there.
Okay.
You follow me? Now that it tested it, right? You could have been short all the way up here and just stayed short this whole deal. You know what I mean? With the anticipation that this is where we're headed.
Right.
And just follow your stops. Just take and put it at a lower high, and you might have got stopped out if you might have not have. But it doesn't mean that you couldn't have found something else over here. Another long or short setup. I mean, another short setup and took it off of one of these other highs. You know what I mean?
Okay.
Knowing that
Yeah.
you're trying to trade down to some of these untested levels, because there again, these untested levels are like magnets. You know what I mean? They tend to act like them until price comes down and touches them. But when they do, just please remember, man, delete them things because they're no longer good.
Once they're retested, they're no longer valid.
Yeah, like there's one right down here at 21.91. And where did it come from? I marked this thing out. It might have been on a 5-minute chart when I marked it out. No, I was on a different time frame. Had to have been because it was a low there. What
Okay.
time frame would I have been on to do that?
And also to kind of add to it, when you place your limit orders, you got it right there at that Bollinger Band, right? Because everything I've learned in the past is you always wait for confirmation that price is reversing. So you wait for like a 5-minute candle to show that there's buyers or sellers, whatever direction you're in.
Yeah.
But you go right off the Bollinger Band, correct?
Yeah. Well, I mean, if you wait for confirmation, you've done got your ass kicked. You know what I mean? Because like your stop's in a horrible place. You know what I mean? Like you've either got to have your stop way up here away from your price. If you've waited for confirmation, you know what I mean? Like that needs to be your confirmation. You know what I mean? Because it allows you to put your stop in such a desirable place rather in harm's way. You know what I mean?
Yeah. See, I keep getting myself in trouble. So that same spot right there at about 6 a.m., right where it drops.
Yeah.
Where it was narrowing down, where it hit the end. So I'd be on the other end in real time trying to buy off that low one, off that first one. I'd be like, all right, yeah, it's hitting the low, and I'd buy it, and it just keeps on falling down all the way till 12.
Yeah. Yeah, and
That's
that's
limited.
it, man. That confirmation deal gets you in trouble sometimes. I mean, you just got to pick your spot. Where is your confirmation at? And for me, it's always the Bollinger Band, and in a rotation hour. In that setup, that Bollinger Band setup, like those three, mean a lot to me. And then if I can add the volume in there, that's even more better. And in there again, back to some of that other stuff that I've done with the VIX, I use it as well. So I just put as many of those things in my favor, man, and I will go play ball,
Okay. I appreciate it, man.
Hey, no problem.
Hey, Meg, on the RTY chart you're looking at here, when you say, you're keeping the box because it hasn't been tested yet, are you talking about only removing that box once an A+ setup tests it, or even if it's like a B+ or an A, that still counts and you get rid of the box?
Yeah, no, I'm looking for an A+, man. That's a retest for me. What we've seen right there, see, I can't remember where that box was. I don't know why I drawn this box. There's a time frame that I am not. I'll be honest with you. I'm wondering if I drew this thing on a 1-minute time frame from a while back and I just forgot to delete it. If so, I'm gonna look like a big dummy. But I don't know. It's something. The reason I drew this box, and I probably just, as little as I trade to RTY, that's probably what happened. I just didn't do it.
Yeah, I mean, I wasn't even talking about this box specifically. I was just trying to make sure, when to remove them and when to keep them.
Yeah, that's it. Just if you can keep them on until you see that actual rejection, delete it. That's ultimately like what I want to see. The box can still be alive at that point.
All right, awesome. Thank you.
Hey, no problem.
So just to be clear, just to follow up on that, if there's a B+ test and it gets rejected, you would keep the box on or you would take it off?
Yeah. So if I seen a B+ setup, I would delete the box. I mean, I would keep the box because all you did was just get a rejection off the box. You know what I mean? Like it wasn't nothing else was accounted for. So you didn't either get the VIX accounted for it or you didn't get the Bollinger Band accounted for it. So, it ultimately just doesn't do anything to the box. I want to see that A+ come in and it show a rejection off of that in order to delete that box. Now, if you was to get like an over-under setup, that's a failed setup. So therefore that box needs to go away. You know what I mean? Like what I was showing you earlier on that 1-minute chart, or I mean that on that 2-minute chart or whatever, it might have been 30-second chart on the NQ. When I showed you that over and under setup,
Right.
yeah, like that part needs to get deleted, because when you showed that setup was failed. So for instance, if this thing right here, if this does not show that this is going to be, so say for instance, this was the rejection candle and we just head down right here, I'm keeping this box up. You know what I mean? Because this box to me is untested. You know what I mean? Like this, for a test to happen, I need to see this and something to this degree happen. You know what I mean?
Understood.
Whether it be here or whether it be over here, it doesn't matter. I want to see something like that to delete this box. Otherwise, this thing is still valid to me.
Okay.
Yeah. But there again, if this thing was to come up here and fail this whole entire short idea and come up here and retest it on the long, this is no longer valid to me at all, period, because it voided everything. You know what I mean? Does that make sense?
Yeah.
Okay.
So say this one did turn into a over-under setup. You most likely wouldn't have a band involved to make it an A+, right?
Lots of times it don't happen. And if it, there's good reason. So a sense of urgency has to come into the market for this thing to really be an over and under, you know what I mean? Like to come up here and actually take off from the top side of the box. So if you're sitting here waiting on this Bollinger Band to come up here and meet it, lots of times you're not going to get it, because there had to be some urgency inside this move to get this thing above this box to begin with. But if you did, I've seen it happen though. I've seen this Bollinger Band come up here, you know what I mean? And these things contract real quick, you know? And you get that price to come down in here, man, that's beautiful. You know what I mean? Because your risk is super small, right? And your upside is just whatever it'll give you, you know? I love being on the long side of the market, you know, if at all possible. You typically that's where your runners come from, you know, the long side of the market. They just keep going and going and going.
So then in that scenario, then you'd probably be waiting for a confirmation candle or, some sort of rejection off the box, obviously, before putting that limit order in at the top of the box in this case.
Yeah. Yep. But knowing your risk, like knowing that, what is your risk ahead of time is going to go ahead and dictate how far, or how many contracts you use, and that's only defined by us or ourselves,
I got you.
Ella de allá de Cabrera, pero él se crió francés y lo que tu apellido es francés.
Hey, if it's not too much to ask, earlier this week you mentioned a A+ one that was looking like it was failing, and it did fail. I actually took a stop on it, which wasn't a big deal. But is it possible if I give you the time and day, you can look at it real quick?
Yeah, man, let's go. What is it?
It's Tuesday the 10th on the 1 minute, about 15 minutes after open. Like I'll wait till you get there first. I'll give you the time. Yeah, so the box set up at 8:34 or 9:34 for you.
Right here.
And the entry would have been at 9:05.
There was the entry, right?
And obviously it didn't go nowhere that time. So that's just one of those occurrences, right, where it just didn't work out, right? Just looking for confirmation.
Yeah, brother. I mean, it doesn't get any better than that in terms of. Hold on one second here. I'm trying to figure out who's Okay. I got it. Sorry about that. So yeah, I mean that to me, I would have had to have taken. Let's just mark this thing up as it is in a long position, right? You're chasing that Bollinger Band, and you're like, oh yeah, this is beautiful. You know what I mean?
Algo así más o menos.
Let's see here.
Si él dice que si te dijeron eso.
15, 16. Yeah, that would have had to been your
En la primera tú depositaste, ¿verdad?
7.
Ahí. Y después, luego, ella te dice.
Yeah. I mean, there ain't nothing you can do about that, man. That's just the way, the way trading is sometimes. But, the only thing that you could do is know your risk ahead of time. Like, okay, well, this is my risk. How can I size this to capture, something like this? You know what I mean?
It wasn't a big deal because that the candle the box set up on, I didn't put too much into it because of the size of it, but it was just the strategy works out so often, so much of the time, that when you see one like that like you said, you're looking for getting ready, all it's looking good, and then it doesn't go, it's actually surprising because of how many times they actually do work out.
And back to that whole over and under thing, I guess if I would have come out with this daggum video a little bit sooner, you had a perfect over and under right here. You know what I mean? Like, you knew this failed as soon as you seen that right there, and this thing right here happened. You knew it failed, so you'd look for the reverse setup, right? So let me get a short position added. So that would be your rejection. Two ticks above. So, 13.75. Yeah, I mean, you just got paid like a son of a gun. You know what I mean? On
that 1022 candle, maybe like that the doji looking one, that might have been the rejection to get on it.
Yep, that one right there. Yeah, just put you in order there. You know what I mean? Like, that's it. And there again, you're not gonna. It happens with such a sense of urgency. If it gets up on the other side of this box, you're not going to get that Bollinger Band poke. You know what I mean? So you need to really kind of look at that box as the spot in which you've seen right there. It was the spot, but you knew your risk, even entering right here, you're just like, okay, well, I know exactly where I got to put my stop, where I'm going to be wrong, and if I'm wrong, I'm just wrong twice. You know what I mean? Like, that's pretty doubtful, that you're going to be wrong twice. Because if this failed, being an A plus, there was a hell of a sense of urgency for it to come in for this move to happen, in which it indeed broke down like crazy, But you could have played both sides of it right there. Lost here a little bit, but made up for a lot of it. I mean, you would have absolutely. Let's see how that would have paid.
That's pretty funny that the example that I picked where it didn't work actually turned out to be an over-under.
Isn't it? That is cool, man. I mean, I'm kind of glad you did, though, because that's how this all works, man.
Essentially, the sellers, the setup didn't work because the sellers were coming through so strong, and so then essentially what you're doing is you're seeing how, like you said, the urgency and how strong it is. So you're essentially kind of hopping on board, and you're finding a good place to do so.
Yeah. And, a lot of people would look at this, okay, well, you just FOMO'd into that. Well, no, you didn't. You know what I mean? You defined your risk. You know what I'm saying? And you would have knew where you were wrong if you were wrong. There's nothing wrong that says you could. You know what I'm saying? Like, where most people would look at this and say, okay, that was a FOMO trade. Not at all, man. It was defined. And you're just sitting here, like, taking your profits like it ain't nothing.
Yeah, unfortunately, I didn't catch the move down here, but I did when it did reverse. It set up with a setup, I believe, and it went fantastic. So worked out.
Yeah, I mean, you would have got filled out on. I mean, I don't know. I mean, how are you trading with 10 contracts? I mean, if you are, you could have got filled out on probably 10. At least 6 or 7 of them. I mean, your 3 right here, 4 would have been right here, 5 would have been right here, 6, 7. Yeah, you would have got paid. That'd have been a beautiful trade. Did I reverse that? Did you happen to notice if I did? I don't know if I did or didn't.
You
Or did
caught
I-
the long.
okay.
You caught the long at like 11:15 there when it reversed off the. I don't know if you were short. I don't think you were, but I know that you caught the long all the way up for the whole rest of the afternoon. I think.
Oh, okay. Man, it's hard to keep up with these days. You know what I mean? Everything runs together.
Yeah.
Tough to. But anyhow, that's how you could have played that, man. You know, that sucks that it failed, but that is a beautiful example of an A+ failing and knowing your risk, and then flipping the script, knowing the sense of urgency, and then still also knowing your risk and taking the trade and still making stinking bank. You know, beautiful. Don't get no better. Really.
Cool. Appreciate it.
Ain't no problem, man.
Hey, Magnum, this is Shimmy again. I have a kind of a macro question. I'm sort of fascinated by your ability to develop multiple setups. I think you've shared with us now, I don't know what it is for, the Magna Cloud Girlfriend, Combine Killer, Bollinger Band Poke. And I'm just curious for other traders, we're learning from you, but also I'm curious, how I could go about developing my own systems and what sort of thing it is that you go through to develop these systems. How do you find them in the first place and develop them and test them and so on and so forth?
Risk. And everything I do is risk. You're not going to do this more than a week if you don't know how to control your risk. So define your risk and build a strategy based upon it. Like where obviously there's turning points in the market. So keep all that in mind. And if you're building your own strategy, keep risk at the forefront of it always and always. And so, if you've noticed, like a pretty common theme with my strategies is I'm more of an extreme guy. Like I'm looking for the extremes. You know what I mean? And trying to dictate, where that is in the middle of the chop, or how do I find the extremes and just go through trading. Just go through the price action and try to figure out where the extremes are. And what you would normally try to do is, once you've discovered the extremes, then you can discover how to put risk management at the forefront of it, and then you just develop from there. Just a step by step process. But as long as you can continue to pay yourself along the way, that matters the most. Along with risk management, that's probably not the most, but it matters a lot. And just pay yourself. You know what I mean? Because it needs to control, take into account risk, and then it needs to take into account human emotion. None of us are immune to that. So I have found over the years trading, and if I can pay myself a little bit here and a little bit there and a little bit here, whether it just be have some good risk management and have my stops at break even, that still don't feel quite as good to a person as getting paid on something. So think about how to get yourself paid, and how can you stay in that trade the longest without taking yourself out, to where you can get paid more and more and more. And I guess that's the best way I can tell you how to start develop it, man, is just, figure out how to control your risk, and how can it match up with your own personal emotions, and just build on it from there.
Thanks. I appreciate it. I guess one follow-up question is, you have these other strategies. I mentioned some of them, like the Magna Cloud, which a lot of people used or still use. And I was just curious, how do you, I don't know if you still trade those other strategies, or how do you decide you're trading the Bollinger Band Poke as opposed to the Magna Cloud, or all of them at the same time? I'm just curious how you kind of combine or divide strategies.
I mean, we all, throughout the year, in years actually, you'll find strategies that work really well for a while, and then you'll find that other strategies work really well for a while. So like always, all of my strategies, I kind of have pretty good risk management, a hold of them. So if I start to notice that, maybe the market conditions are changing, I'll just pull one of them other strategies out of my toolbox and start to use it a little bit. You know what I mean? I'll figure out which one's working best, and lots of times you can pair that up with a VIX. And a VIX will tell you a lot about certain stuff, where things are getting priced in and where they're not. So, situations like this, low volatility, in relative terms, this strategy right here is super good. During times of really high volatility, the Magna Cloud works really good, and so so does some of that other stuff. It especially like when it's some of that Fibonacci stuff, when you're utilizing the Bollinger Band as well. It works really good in really high volatility times, because you get these, multi-100-point days. It's pretty incredible, and you can be a part of it all, with relative low risk. So it's just market conditions. That's all it is. It needs to match up with whatever market conditions is going on, and it's up to us to figure that out. That's the only thing I can say.
Got it.
Ain't no black or
We
white.
could be flexible and adapt to market conditions as they develop and change over time.
I always say, man, you better be fluid in this industry, because it'll change quicker than you are, can. But yet, if you're fluid enough, you can change pretty quickly with it, But there again, without that risk structure and that, really good risk gain, you ain't gonna be able to sustain that pivot of, having to swap over. So that's important.
Thanks.
Ain't no problem.
Piggybacking off that, I feel like this strategy, I mean, the Combine Killer and the BB version of it, I feel like even for higher volatility, I mean, some of the days we've had that have been a bit more wild with real big, hundreds of point drops and all that, it seems to work exactly as good. It just pays out more. I mean, yeah, it might be a little bit more risk, but it seems like it still works fantastic.
Yeah. I mean, I ain't never had a problem. I've used Bollinger Bands for a long time, man. And I've used this strategy for a long time. And it may just be one of them deals where it's just, what's the appetite for the day? You know what I mean? Just, some days, I tell you what, man, I've made more money, using that fib strategy than I have with any strategies, quite frankly. It really allows for some levels, but there again, you're talking in high volatility times. It doesn't work so good in low volatility times. But when volatility is high, it usually gets you on the right side of things, and holy smokes, that thing just kills it.
Mag, are you talking about the Magna Cloud strategy with fibs?
Yeah, that's it. Yeah.
Okay.
Yeah, with the high volatility, I'm telling you that strategy right there will outperform most likely anything that I've done. It's tough. You know what I mean? It's just tough to, because you can size into these things so stinking big, and you're trading like 160 points. You know what I mean? On some big contracts, and it's like, whew, those are some juicy days. But there again, it's got to match the volatility. If the volatility is not there, that strategy falls off. You know what I mean? One will fall off and one will pick up. But having all them tools in your toolbox, it just allows you to be, able to participate in anything. But if you can withstand some of these big candles and size inappropriately, this strategy right here will perform really well too. Because it gives you some good exact points, but you've got to size in appropriately, because when you're wrong, it can hurt, and the Magna Cloud's the same thing. If you size in too much or whatever, it can hurt you as well. So it's kind of a trade-off, Yep.
So that screenshot
I didn't catch what he's saying there.
The screenshot I posted up on Friday on the 30-second chart on the retest of the Bollinger Band box. I should have been looking at it longer.
Let's see here. 30-second chart on a.
239.
239. Oh, well, you said 30-second chart. Okay, I'm sorry. I'm looking at a 1 minute chart.
Yep.
239.
Okay.
Oh, sorry. 239, you said. 239, right there.
It was kind of under and over. It retested twice.
Yeah, I almost didn't it? Yeah, it was almost over and under. There's an A+ setup right there.
That's where I took it long. I was in for 9.
Pretty. Beautiful. Beautiful. Yeah, I mean, like, right? So we'll use a.
I took it long right after that doji, right after that indecisive sumbitch right there. I got in actually on the third candle that after the poke.
Yeah, right here.
That's where I got in. I wrote it to 359.
Hey, there you go. So your initial risk, you would have known, right? Would have been what, a couple ticks below that candle. So your risk would have been from 3, almost 4 points, right? If you would have got in on the A+. Say you got in here, your risk would have been still 6 points or less. So when you seen that second candle and you seen that close above it, you can move your stop up to here. Yeah. And then you just got stinking paid, man. You know what I mean?
Yeah, good trade.
Yeah. That's beautiful.
And I actually put my stop at the bottom of the box is where I put it. But
Yeah.
I see what they're saying now. I'll start looking at that lower wick. But yeah, I had to stop at the bottom of the box.
Yeah. I mean, there again, I mean, we all got to be honest with ourselves, man. Like, it's tough to get this right here. You know what I mean? But just knowing, the strategy, right? If you had if you had it down here, initially because of the wick, and once that second candle closes above, you're good. Just pull that thing up here, and it's still safe. If the setup is valid, it's just for whatever reason, news was to drop, you're not going to take that big loss. Versus a couple points. It's kind of, that's all it is. It's just risk management, but and that's all personal preference. I mean, it's as long as it is. If you sized in appropriately to keep your stop down here, man, and keep trading that thing the way you're trading it, there ain't a daggum thing that says that you can't do that. Like, I mean, it's you just really ain't. As long as it fits your appetite for risk, it's all up to each of our own. But that sure was a good one.
I appreciate your time. Thank you, sir.
No problem. Well, guys, anybody think anything else there?
Sounds like not. I just want to thank you so much, man.
Yeah, I was going to say the same thing. Thank you.
No problem, guys. Anything I can do to help you and try to get a little better at this thing and share a little bit of knowledge. That's all. I just good to hear it's helping some folks out, man. But well, if you guys are good, man, I'm good. I'm gonna go get ready to eat some dinner and call this thing a day.
Thank you, man.
Very
Hey,
cool. Take
no
care. Have a good
problem.
night.
See you, bud.